Okay, let's dive right into this explainer. Over the last 24 hours, the financial technology sector has been absolutely electric, and we're going to decode exactly what happened by looking at three massive, landscape-shifting power plays. If you follow fintech at all, you know things move incredibly fast, but we've just witnessed a fundamental shift in how the biggest players are structuring their long-term futures. This isn't just about launching some shiny new app features. No, this is about fundamentally changing the plumbing of the entire financial world.
Honestly, looking at the fintech landscape right now, it is as chaotic and high stakes as the World Cup group stage. Companies are making incredibly aggressive, stoppage-time moves to secure their long-term survival and dominance. We're seeing penalty shootouts in the form of massive regulatory filings, deep government integrations, and enormous buyout interests. It's an absolute scramble to see who gets to advance to the next era of finance and who gets left behind paying rent to the actual owners of the system. The stakes literally couldn't be higher for these platforms.
So here's our agenda for today. 1. Klarna stops renting. 2. A government brokerage pipeline. 3. Banks buy the rails. And 4. The ultimate fintech takeaway. Together, these stories brilliantly illustrate the massive transition happening right now, moving from simply renting financial infrastructure to outright owning it.
All right, jumping into Section 1, Klarna stops renting and applies for a bank charter. Let's look at why they're officially tired of asking for permission to be a bank.
This strategic pivot is absolutely fascinating. On July 6th, Klarna basically said, "We're done." They submitted robust applications to both the Utah Department of Financial Institutions and the FDIC. They are pitching a massive shift from renting a charter from WebBank, which is how most fintechs get off the ground, to owning their own Utah-chartered industrial bank outright. It'll be called Klarna Bank USA, led by Utah banking veteran Gary Harding. Ultimately, they want to stop running their massive global business through someone else's balance sheet. See, when you rent a charter, you're always subject to the partner bank's risk appetite, their compliance overhead, and of course their margin cut. Owning the charter, that changes the entire economic model.
Now, why the sudden urgency? Well, it comes down to this number right here, $91.3 billion. Since 2019, Klarna has extended over $91.3 billion in credit to U.S. customers alone. That is a staggering amount of money to process while essentially acting as a tenant in the banking system. When you're moving that kind of massive capital, the economics of renting your infrastructure start to severely break down. You face major margin compression because your partner bank takes a cut of every single transaction. Plus, you're heavily reliant on their compliance team just to launch new products. Basically, at $91 billion, you don't want a landlord anymore. You want to own the real estate outright.
And Klarna is bringing a pretty bulletproof argument to U.S. regulators to make this happen. I mean, they already serve roughly 30 million Americans every single year. They estimate they've saved shoppers around $5.1 billion compared to traditional revolving credit card debt by using their buy now, pay later model. But the most crucial point for regulators, they've already been operating successfully as a fully licensed bank in Sweden since 2017. Regulators know this isn't just a shiny tech company playing dress-up. They actually know how to manage capital requirements and risk. And they aren't alone here. We're seeing a distinct trend as they join companies like Revolut and Bunk in this aggressive race for U.S. banking charters. The era of the lightweight fintech wrapper? Yeah, that seems to be closing for good.
Moving right along to Section 2, a government brokerage pipeline and Robinhood's infrastructure role. Let's see how they are securing the next generation of investors. To fully grasp this move, we have to look objectively at what's happening at the federal level with the new Trump accounts. Launched officially on July 4th, this program provides a $1,000 seeded investment account for kids born between 2025 and 2028. It's a major federal initiative aimed at giving the next generation a financial head start. For the broader financial market, this is massive because it creates guaranteed long-term assets under management from birth. We are talking about millions of accounts being funded and locked in for nearly 2 decades before these individuals even enter the workforce. And right at the center of this launch, Robinhood. CEO Vlad Tenez actually attended the first ever opening bell at the White House on July 6th. Sure, it's a great photo op, incredibly good for brand visibility, but the real takeaway here is the underlying strategic business infrastructure being established. Robinhood is moving way beyond just being a consumer trading app on your phone. They are embedding themselves into the foundational layer of a federal wealth-building program. This shifts them from a platform you actively choose to download in your 20s to an institution you are essentially born into.
See, Robinhood wasn't just there for show.
They were officially selected by the Treasury, right alongside legacy heavyweight BNY Mellon, to actually administer the program. Robinhood built the specific tracking app that families across the country will use to manage these federally seeded funds. This creates a government-endorsed pipeline, funneling millions of new, fully funded accounts directly into Robinhood's infrastructure before these kids even know what a stock brokerage is. They just essentially became the default financial home for an entire generation, expanding their footprint way beyond their standard retirement, trading, and education products. Frankly, it is an absolutely brilliant customer acquisition strategy disguised as federal infrastructure.
Okay, Section 3, Banks by the Rails, featuring Fiserv's potential Star Network sale. Time to flip the narrative.
If the first two stories were about fintech stepping up, this one is about traditional banks stepping in. This is literally the fintech equivalent of your landlord asking if you just want to buy the building outright. For decades, traditional banks have paid hefty routing fees to access digital payment networks. Classic renting model, right? But now they're seeking direct ownership of the exact infrastructure they currently rent access to. It represents a massive shift in market dynamics. The legacy players are realizing that instead of paying a toll every time their customers swipe a debit card, it might be vastly more profitable in the long run to just buy the toll road themselves.
To wrap your head around the scale of this, look at the network's reach. According to preliminary Wall Street Journal reports, a consortium of heavy-hitting legacy banks, we're talking JP Morgan, Bank of America, Wells Fargo, and PNC, are all in active talks to acquire Fiserv's Star Network. This debit network is no small niche player. It routes transactions for a staggering 115 million cardholders across more than 2,800 financial institutions. Think about that volume for a second. The very banks that generated the transaction volume that made Fiserv's business model possible are now shopping to cut out the middleman and take a piece of the pie for themselves.
So why now? Well, in high finance, timing is everything. Fiserv just went through a major CEO transition, with Takis Georgakopoulos stepping in to replace Mike Lyons. At the exact same time, you've got activist investment firm Jana Partners breathing down their necks, publicly pushing the company to sell off non-core assets, shake up its board, and streamline its focus. When activist investors get involved, companies look for immediate ways to unlock value. Selling the Star Network fits perfectly into that streamlining strategy. And the market? They clearly love the idea of Fiserv shedding this weight. Their shares jumped as much as 7% just on the Wall Street Journal report of these preliminary talks.
And finally, Section 4, the ultimate fintech takeaway and blurring the lines. Let's bring it all together.
Let's pull all these threads together. The biggest thing you should take away from this explainer is that the era of strict, clearly defined boundaries in finance, it's completely over. The lines between a nimble fintech startup, a legacy banking institution, and foundational government infrastructure are officially erased. We have fintechs like Klarna actively applying to become fully charted, traditional banks because they've outgrown the rental model. We have consumer retail platforms like Robinhood securing direct government pipelines to act as core federal infrastructure for the next generation. And we have traditional legacy banks forming consortiums to shop around and permanently own the fintech rails they've been renting for years. It's a complete structural realignment of how money moves and who controls the ledger.
Which leaves us with this final, crucial question to chew on as we wrap up. If the fintechs are actively becoming banks, and the legacy banks are pooling their money to buy up the fintechs, what does the word fintech even mean anymore? The technology is no longer a separate, disruptive layer on top of the financial system. It is simply the new, undeniable foundation of finance itself. Thanks for joining me on this explainer. Keep an eye on these massive power plays as they develop, and I'll catch you next time.